Going on, everybody? Thank you so much for checking in. In this video, we're going to go over Broadcom, which just recently reported their second quarter earnings, and the company is up more than 10% after that report, leaving many to wonder if it's still worth a buy now that it is trading at all-time highs, or is the stock likely going to top out soon and begin selling off? So before we jump into this video, we do have to highlight the fact that Broadcom is a major player in the semiconductor industry, which means that the momentum that artificial intelligence has gotten in the last few years has really driven them to these all-time highs that we're seeing right now. This is not purely based on numbers. Yes, the company has posted fantastic quarterly numbers quarter over quarter, but when we look at their trends, their quarterly trends have actually been about flat. In fact, even though they jumped on these earnings, their numbers still weren't as good as they were last year. So that's something to consider if we're looking at profitability. One of the biggest drawdowns that's happened for Broadcom happened from Apple. Apple happens to be the biggest consumer or the biggest customer from Broadcom, specifically for their iPhone chips. Now, when those iPhone chips start slowing down, or when iPhone sales start slowing down, such as they did in the last quarter, Broadcom's revenue is expected to take a hit. But what did help them this quarter was their earnings growth, specifically from artificial intelligence. So artificial intelligence, of course, is the biggest demand right now for Wall Street. We're talking companies like your Microsofts, your Googles, your AT&Ts, your Intels, and so on and so forth. Anybody who is recognized as a CEO or as a publicly traded company right now, they need to be implementing some kind of artificial intelligence. And of course, that's what rescued Broadcom on this specific earnings call. We can see that their AI product sales increased to a record of $3.1 billion during that quarter, offsetting the slowdown from iPhone sales. So that actually really helped them. And not only did it do that, but the company also raised their guidance for the next year. So you can see that 2024 guidance went from $50 billion to $51 billion. So it's not much of a change, but there's nothing that investors like to hear more than increased guidance. Increased guidance is almost a trigger word for investors because it just shows that the company is now expecting to make more than it was already making before. One thing we have to know is that the momentum in artificial intelligence as a whole is going to drive these stocks higher. But when we analyze the numbers a little bit deeper, we see that this company is actually a little overbought. And so if you're considering purchasing and holding for years and years to come, this is a company you might want to ease into. Yes, because of the excitement around the split, there's a split that they announced that's going to happen in the middle of July. Because of that stock split, the company may rally forward. However, when we're looking at their numbers, let's dive a little bit deeper. We see that we are starting to see a little bit of a struggle in terms of justifying their market cap. Broadcom's annual revenue last year was about $35 billion. One of our favorite tests to do is we take the annual revenue of the most recent year and we multiply that number by 10. That gives us about $350 billion. So we're going to compare that $350 billion to the market cap that Broadcom has. If we take $350 billion and we compare it to Broadcom's market cap of $800 billion, we clearly see that they're double what they're projected to make in the next 10 years. Now, for us, that means the company is overpriced. What we like to see is a company like Apple, where the company is bringing in about $400 billion in revenue and the company's market cap is less than what their projected revenues are over the next 10 years. You can clearly see the difference between a healthy company and a company that may be overpriced. So with that being said, when we see Broadcom trading at all-time highs, as experienced traders, we understand that the overall momentum of the sector is helping drive this trusted name higher. Something you have to remember is that semiconductors and artificial intelligence, the artificial intelligence may be a new topic for Wall Street, but semiconductors have long existed. And the trusted names like your Broadcoms and your Nvidias have really grown over the last 12 to 24 months because they're pre-existing companies and they already have Wall Street's trust. And so these companies naturally saw some of the biggest inflows of capital, but that also led to these companies being overpriced. When we look at Broadcom's price to earnings ratio, we also see that it is around 72. 72 is a little more expensive than what we like. We always like to buy companies that are trading between between a 15 to 25 price to earnings ratio. That's the healthy spot that we like to buy at. So Broadcom obviously a lot higher than that level, so that still makes it a little bit of an overpriced company. Another thing to notice about Broadcom is that their year-over-year revenue has significantly slowed down. I mean, they're talking about one digit percentage gains versus other semiconductor companies that are growing at double and triple digit percentage gains. So with that being said, is Broadcom the best bang for your buck right now? And the quick answer is no. This isn't the cheapest. This isn't the best company to buy. Yes, they're a trusted name. Yes, they pay a dividend. Yes, they've been around for years. And yes, they're growing steadily. But we don't really see that this company should be valued at what it's at right now. Now, take that with a grain of salt, because right now Wall Street is so gung-ho about semiconductors and artificial intelligence that they may keep running this player up, and it may run into the trillion-dollar market cap, adding another 30 to 50% to its market cap. But that's not necessary to happen. But in order for you to capitalize on a move like that, you need to also learn how to read some charts. So, of course, while we covered the numbers, that was very important in terms of fundamentals. We always have to know the fundamentals of the stock that we're trading, because when the time comes that a correction happens, those are the stocks you want to keep in mind. That way you can begin unloading your position or entering on a pullback. We'd be more than happy entering Broadcom if it was to cut its price by about 25 to 50%. We would purchase a very large amount, but as is right now, we're more focused on maybe trading its levels rather than buying it for a long-term investment. And so here are some levels to focus on for Broadcom. Obviously, the stock is seeing a massive upside move. When we did our pre-earnings analysis on June 11th, we expected the stock to give us a $153 move after its earnings, and the stock did indeed give us that $153 move. In fact, it gave us about a $200 move. Now, following those earnings and following their split announcement, remember they announced a split that's expected to take place on July 15th. We also saw what happened when Nvidia announced its split. It continued rallying. Now the question is Broadcom going to follow suit? So let's take a look at Broadcom. Let's take a look at the closest expiration in terms of options to its split and see the expected move. When we pull up the option chain for July 19th, which is 4 days after the split, we see that the option volatility is currently around 42%, which translates to about a $180 move. So between now and July 19th, the market is expecting a $180 move on the stock. So that means our price target on Broadcom is either going to be upwards of 1900. So I'm assuming they break out of their most recent highs around 1735. Their price target above that is going to be right around 1900. But if they don't and they fail to make that breakout happen, say they break the support, our support here in this case is going to be 1650. If we take roughly 200 out of that, then we're looking at a move back towards 1450 to 1480. We're going to call it 1480 to be safe. So with that being said, we know the expected move is about $180. Here are some levels that you need to focus on. As we already mentioned, you have your support at 1480, which would be the target below the 1650 breakdown if it breaks below 1650 between now and July 15th. And then of course, above the resistance of their most recent highs, we're going to call those 1740. Above that resistance, our price target is going to be right around 1900. Let's go ahead and type that in. So all in all, you guys, now you have your resistance, you have your supports, you have your expected move, and we have an idea of what the foundations look like for Broadcom. Yes, the company is moving off that excitement around their stock split, but when we look deeper into their numbers, considering the slowing iPhone sales, considering that their revenue is not growing as nearly as quickly as other artificial intelligence involved companies, this company may be a little overpriced. By the time it splits or after it's split, we may begin seeing a correction to the downside from this name, potentially moving it back below the 1480 mark.